welcome everyone. I really appreciate everyone coming here tonight. It's obviously an unusually crap night in Melbourne. Feels like we've brought some weather down from Sydney, John. So thank you very much for attending. So I just thought before we start with John, we'll just have a quick presentation about the team, because a lot of you would have dealt with myself and Heather over the years, but we've really increased the size of the team in the last 12 months. That's me, Photoshop. Still probably could do a bit of Just for Ben looking at that. But anyway, so Senior General Manager Financial Planning here. Most of you have met me. If I haven't met you, I'm happy to have a chat to you. Met a couple of people today for the first time, which is awesome. Katie, who's been with us for nearly 12 months now, is a very experienced financial planner. Let's be honest, she's better than me. So, you can certainly... What happened there? We're on timer again. Jumped. Okay. So Katie is a very experienced financial planner, has been a financial planner for been in the industry for 15 years, more than 15 years. She's specialises in retirees and pre-retirees. Michelle, who's joined us with a number of her clients, she's both a financial planner, has been a financial planner and a lawyer. So those that haven't got your estate planning done, we're getting it done in the next couple of months, okay? So we can do that in-house now. Michelle's going to be relationship manager, basically someone to talk to about how you're travelling and everything else. And then on the next page, we've got Heather, who's part of the Furniture and Henry Group. Been 22 years almost, so she's been there. A lot of you would have dealt with Heather over the years. Sally, who's running the show tonight, so hopefully it works well. I'm sure it will. She's been with us for 6-9 months and is also with support, part of our support team. This is not a good sign. We got a timer going on or something. We need to have a look at this. Yeah, it's true. It's a good way to finish my conversation, yeah. And Kim, who will be review manager, so she's been with us for 6-9 months if your reviews come up, you'll get an email from her and we'll contact you about getting your review done. Just quickly, I know most of you are clients here, but just the things that we can do and how we can help both people in this room but also others. So certainly those people leading into retirement, so in your 50s or 60s, about how you're tracking towards retirement, making sure that you can do what you want to do in retirement, and we can help you with that. Cash flow savings is something that we can certainly assist with. If you've got a savings capacity, making sure you're making good decisions with your money, making sure that, if you're still working, that you are putting some money aside. Protecting your wealth and estate planning review. As we said, we've beefed up our services by having a in-house solicitor. Assistance with goals and objectives, that's what we're here for. We're here to help people with these types of things. Aged care, hopefully no one in this room, although it has impacted a couple of people in this room. It is important that that we, if you need help in that area, that we can do that. Obviously, lump sums. If you come across an inheritance, we haven't had too many Tats Lotto winners. Happy to help there. And anyone who wants to get ahead financially, I think is areas that we can help do that. And we've obviously got our 8-step process. A lot of people in this room would have done our 8-step wheel. That ideally that becomes rounded over time, and that you turn that as 10 out of 10. All right, we're going to have a minute to try and fix this issue, and then I will introduce John. I can start doing that while Sally is doing that. So who either was at the presentation last year in our very cramped little room that we had, or I know you were there, Russ, or who listened or watched it on Zoom. A few of you, which is awesome. So does anyone remember it? Sorry, John, that's a bit harsh, isn't it? Has anyone got any key takeouts from last year that they remember? Let's see if the crystal ball worked, because one thing did work, and I'm going to talk about that in a second. So anyone... remember, anything? Okay, so the thing that I remember most out of the presentation was stay away from long-dated bonds. And considering that after he made that comment, the 12 months afterwards, long-dated bonds were down more than 10%. That was genius from John, or pretty obvious common sense, you could say, by others, with the way interest rates were going. But, you know, we had structured a lot of our portfolios. Yes, we still had fixed interest exposure, but they were in short duration rather than long dated. So yes, they were still negative because everything in fixed interest was negative, but certainly not the -10. It was more your -1s or -2s. So that was to protect the portfolio a bit. So John got that one right, and one of the reasons that we really, really like John is that he is not your usual economist. He did compare himself to Jimmy Carr before, which is dangerous, but it's good value, Jimmy, but yeah, not necessarily as an economist. But you know, particularly Katie and I, we listen to a lot of economists a year, which is, yeah, anyway, part of the job. And most of them are pretty dry. Most of them use too much jargon. Most of them certainly aren't as entertaining as John. So we've got John back basically because the feedback we got last year was overwhelming, that he's exceptional, and so he's really backed by popular demand. So those of you who you know, weren't here last year or don't remember John's bio, which most of us won't, John has been in the industry for more than 40 years, focusing on helping Australians build and protect their wealth. Investment management has been John Abernethy's sole career passion. That's pretty sad. Since he graduated from University of New South Wales with a Bachelor of Laws in Commerce degree, so that's awesome. He's proud of his career roots with NRMA Investments. That was a mutual at the time, focused on member service before profits. In his 10 years there, he reached the position of Head of Equities and Assistant General Manager Investments. And testament to his attention to service quality and communication is the Independent Financial Planners voted NRMA #1 investment manager during his tenure, which is really impressive. John founded Climb 27 years ago. It's been around for a long time and has carried that same NRMA ethos with him, ensuring that going the extra mile for advisors and client is part of the company's DNA. So without further ado, I have the absolute pleasure of introducing John Abernethy tonight.
I'm using that, am I?
Apparently.
It's in my pocket. So last year was free, this year I'm charging because of that fantastic wrap. But welcome everyone, and I'm very happy to be here. I hope that microphone works. What I want to talk about tonight, I'll just put the disclaimer up because in case anyone thinking it's suing me, so you can read that while I talk. But I want to talk about macroeconomics and try and make it entertaining and educational. I think the great value of macroeconomics and economics generally, but macro, is it explains the past very well, explains what's happened in the past. Economists are very good at telling you what happened, okay, so I'm an expert on that. I can tell you exactly what happened today in the stock market. It also gives us an insight to what's happening today, okay, so we can understand the past, put it in context and understand what's going on today and join the dots. And I'm going to join dots between various markets and various forces which affect the price of assets, in effect, because we invest in assets. That's what you invest in, and you're looking for a return from those assets, but you've got to see what drives that return. There's intrinsic value and there's also headwinds and tailwinds which affect price. Okay, we'll talk about those as well. But the other thing that from macro, and I think this is where people think too much of it, its predictive powers are not that great. They're interesting, but what I think I can do is explain the past, explain the present and draw conclusions from that, as opposed to giving you some waffly sort of thing, what's going to happen into the future based on macroeconomic analysis, if that makes sense, okay? So the real power is explaining where we are today, and from that we can draw some conclusions. You've all read that? So you can't see me. Good. Okay, I'm going to do a quick where are we today and where have we been? But I want to start with this. I think one of the biggest issues you've all got, and you're going to make an assessment of me tonight, so I hope it's good, but we'll never know until we get to the end, which is what, is it 4 hours time, Michael? How much did you get? Does anyone want to watch maths tonight? You do? Oh, crikey. What time's that start? Can you tape it? Yeah, good, great, thanks. Okay. I can tell you what's going to happen there. I can actually, because I've seen the shorts, okay, but I think we should wait till Sunday night. The whole thing's rubbish, isn't it? Okay, but come on. You know, we've got to have our brain down time. Anyway, what I put this here, we're all getting bombarded with information, and you're going to get a bit tonight, but hopefully it's balanced. Where we read so much, we hear so much, we're on social media occasionally, we're just bombarded with opinions, okay? And a lot of journalists are now writing opinions, and they're opinionating on everything. You know, bank collapses last week, let's get panic. Interest rates going up, let's panic, you know. Energy prices going up, let's panic, you know. And there are some reasons to be concerned, but what I'm saying to you is you get a lot of opinions, and I don't think a lot of that opinion is well-based. I don't think the people giving the opinion have the experience to give it, and I think even worse than that, a lot of opinions are biased. So a lot of fund managers or trading fund managers, hedge funds, you heard about them, investment bankers, will give you advice, but they're giving you advice which is tainted by their trading in the market. So when they're short the market or negative on the market, guess what? They want you to be negative as well, so they can make money. Okay, they want to drive sentiment. Okay, and I'll explain that as I go through the presentation. But I grabbed this. This was in the Australian Financial Review about 3 weeks ago, and it was written by a fund manager who's a bond manager who should know better. I'm not going to name him because this was an embarrassing article. And my point was, I read it, and because I've got 40 years experience and I've played equities and bonds and fixed income and credit, I could immediately see what the problem was with this article. Now, I'm not going to ask you to work out the problem because I'm going to tell you, save you the hassle. But he wrote this article, and if you can scan it, but it's a much bigger article. He quoted a press conference which was held in New South Wales. So New South Wales Treasury had a press conference 2 or so years ago and said effectively, look, we think we can raise $20 billion of state government bonds for 10 years, so a 10-year bond, and the market rate is 1%. So we can raise $20 billion at 1%, okay? And what can we do with the $20 billion? They had this throwaway line, oh, we could even buy the share market and we would do better than 1% over 10 years and we'd make money for the people of New South Wales. Now this guy claims, and I think he did this, he jumped up and down in the audience and said, you can't possibly be doing that. Why would you raise $20 billion at 1%? What happens if we get inflation? What happens if we get inflation? What are you going to be paying for that interest? You're crazy, you're borrowing $20 billion. Now what was the fault of that comment? Now this New South Wales state government didn't raise the $20 billion at 1%, and he claims that he was the person who pointed out to the New South Wales government, don't do that. So what did the New South Wales government do? Rather than raising $20 billion at 1%, they sold WestConnex, a toll road. So the people of New South Wales now, they raise their money, but the cost of that money is the toll. And the toll goes up every 6 months by 4%. So rather than raising $20 billion at 1% and holding WestConnex, this character reckons that he convinced the New South Wales government not to raise $20 billion on the argument, the spurious argument, that they would have lost money if they'd have done that. Now, if you read that and you just read it quickly, you think, oh, this guy's a genius. He has incredible power. He stopped the New South Wales government raising $20 billion. And he actually got it totally wrong. The New South Wales government should have raised the $20 billion at 1%. They could have at least built a hospital with it, they could have built a school with it, a university, whatever. And this is exactly how these commentators confuse you. And even smart commentators can confuse you. I'm going to try and confuse you for the next 2 hours. I'll do my best anyway. But he said, had this plan not been stopped in its tracks, New South Wales government forced to preemptively reduce its debt by $11 billion, the state coffers would have been trashed. It's absolutely wrong. The state would have had $20 billion, they would have been paying 1%, and interest rates are now 4 or 5%. They would have been saving 4 or 5% a year on the market rate and saving the New South Wales people $1 billion in interest. He's totally right, but he wrote that, right? He didn't understand the difference between an issuer of a bond, those who borrow at 1%, and those who buy that bond at 1%. The guy who bought the bond lost the money, not the guy who issued the bond. He totally got it around the wrong way, trying to make out that he was very clever. And he wasn't clever at all, he was stupid. But the AFR didn't realise it. I rang them up and said, do you realise this article is totally wrong? One of the sub-editors, and said, this is totally wrong, this should be taken off, because this actually, I don't want to defend the guy, but he's looking like an idiot. Anyone who knows what they're talking about will see this guy's an idiot. Anyway, So be it. So, no, the buyers of the bonds would have been trashed, not the seller of the bond. And then all of a sudden, what happens 3 weeks later? The buyer of a bond called SVB Bank, I think you've all heard of SVB, went broke last week. The buyer of bonds went broke because they bought bonds in America. I don't know whether they paid 1%, got 1% yield, or got 0 or 0.5%, but they were a classic bond holder. And when the bond market yield went up and the bond prices fell, they went broke. So it's the owner of the bonds who takes the risk, more so than the issuer. So that's how I wanted to start. I wanted to start by saying not everything you read is sensible. You know, I know a lot of you say, we can't be bothered reading anymore, we just rely on Hendry Group, which is good. That's what you should do. Michael, they're relying on you. Are you reading tomorrow's press already, are you? You know, but what I want to do in the next hour or so is just go through what's actually going on and let you try and work out for yourself whether what I'm drawing out in conclusion is fair or reasonable, is it based on fact, or is it speculative, okay? Because the world is full of speculation, the world's full of opinion. So let's start from reality. Where are we? There are a lot of issues to address in terms of managing portfolios and managing your pension funds. You can see them all. I call these white swans because I can put them on a bit of paper. They're the white swans. They're the swans we identify, we can see them. It's the black swans, which you heard about the black swans, they come out of nowhere. And then we've got Donald Rumsden, or whatever his name is. Can you read that? As we know, there are known knowns. There are things we know we know. We also know there are some things we do not know, but there are also the unknown unknowns. The ones we don't know, we don't know. Pretty clever for a American politician. Yeah, so they're the black swans. And SVB was a black swan. Okay? And a couple of other banks are black swans. They're not very big. I think they're black swan. What's a small swan called? Baby swan? Cygnet. Yeah, it's one of those. It's a black cygnet. It's not that big. A white swan was Credit Suisse. That was a white swan. Credit Suisse has been going broke since the GFC. The fact that it survived this long is amazing. Okay? It's also amazing when you think about Credit Suisse was one of the biggest banks in the world 20 years ago. It was a top 10 bank. When it was taken over on the weekend, I think it's $3.5 billion US or something like that, it was valued at about a 20th of Commonwealth Bank in Australia. Okay? A 20th. And so you might have read on the weekend how scary this all was. SVB, which was valued at 100th the size of Commonwealth Bank, 100th, and Credit Suisse, a 20th or something of the size. And we were told in the press last week we should all be concerned about what the effect of those collapses would be. Now, I wasn't concerned, but I was concerned about the market thinking they should be concerned. The prices were falling, and then people start looking at prices falling and think, well, what does the market know that I don't know? Okay? And then you start thinking, well, what sort of market are we in? What sort of market have we created since the GFC in particular? And then that gives us the answer. We've actually created quite a perverted market. And that perversion, for want of a better word, is created by quantitative easing. The printing of money and the compressing of government bond yields, which gave New South Wales government the opportunity just 2 years ago to raise $20 billion at 1%. Who would give them $20 billion at 1% is interesting to think about. But that was the market. There was an active market, and people representing other entities, so there were people making decisions, were quite prepared to lend the New South Wales government $20 billion at 1% if they asked for it. In Germany, people representing institutions and pension funds were quite happy to lend the German government 10-year money at a negative yield. And they were representing people who were investing. So the perversion is great. And what we're going through now in this cycle is the end of perversion and into a new cycle. So the perversion cycle is the GFC interest cycle, the post-GFC cycle. So that cycle has ended. But what was that cycle? We had printing of money, we had driving down of interest rates, bond yields went negative, not only below inflation, but negative in Japan and Europe. Negative yields, very low yields in Australia and America, North America. Fiscal policy, well, when you say to politicians they can borrow money at no cost, what are they going to do? Borrow a lot of it, you know, because they can win the next election based on that. How much can we spend of this money which we don't have to pay interest on? So they go and make all these promises. Okay, then we had the COVID crisis, and don't worry about it, we can print more money. And we came to Australia. You know, we printed $300 billion Australian dollars during COVID. And we pushed our interest rates down to zero. And that was only 2020, 2021, not that long ago. Okay. We've had a ballooning of government debt, and debt became no problem because there was no interest. Didn't have to pay interest on it. Doesn't matter how much debt you've got. Ask Japan. Japan's got 250% debt to GDP. What's that mean? Their economy is about $4 trillion US, and their debt is $10 trillion US. $10 trillion. That would be like the Australian government having $5 trillion of debt. Now, $5 trillion of debt wouldn't be a problem for us in this room if we didn't have to pay interest on it. How much more can we get? That's what your kids, remember when your kids said, can you lend me money? And you go, should we charge them interest? But you say, no, they're our kids, we won't charge them. If you don't charge them interest, how much more can you give me, Dad? No interest. Borrow now, pay back later. Promise. Yeah, it doesn't happen. And the biggest thing was bond manipulation. We pushed yields down to zero, and the bond yield, for instance, the American 10-year bond, is what we call the risk-free rate of return. So the bond asset is regarded as the lowest risk asset in the world. But what happened, and as I told you last time I was here, if you can remember, the lowest risk asset became the highest risk asset in the world. A bond for 10 years yielding nothing is a high risk asset. You can't make money on it, you can only lose on it, unless we have a depression. Depression would drive it into negative. What a way to invest. Invest for a depression to make money. You know, who does that? No one does that. Anyway, so that cycle's over, and we've moved into this new cycle, which is called post-COVID. So that was GFC pre-COVID, now we're into post-COVID. What's happening now? Inflation has appeared. Remember, in the pre-COVID era, we were trying to get inflation. Remember that? We had Reserve bankers trying to say, can we get 1 or 2%? Please, we want 1 or 2% inflation. We'll do anything to get 1 or 2% inflation. We'll print as much money as we can. Can we please have some inflation? They couldn't get it. But the economic theory was print money, get inflation. And everyone quoted Germany in the 1930s and Zimbabwe in the 1980s or something, you know. Everyone had these anecdotes. Nothing worked. We couldn't create inflation. Why was that? I was trained at uni that if you print money, you get inflation. It didn't happen. So something's gone strangely wrong. Cash rate. So now we've got cash rate increases, no more so than Australia. And we'll talk about the Australian interest rates compared to America, because that tells us where the Australian dollar is going. So we've gone from cash. Remember, cash in Australia was 0.1? 2020, 2021. RBA told us no interest rate increases for 3 years. 0.1. You can bet the bank on it. Your kids can bet their house on it. They have. So we've gone from 0.1 and cash rates in Australia 3.5% give or take. America 4.5% give or take. Long dated bonds, which I said last time, don't even touch. Even though their yield has moved up and there's been capital losses made, they're still mispriced. So it's still not time to buy long dated bonds. But people are. The long dated bond market's rallying in the last week. The things that rallied in the last week. So we had a SVB crisis, which disappeared. It's no longer a crisis, it's dead. Credit Suisse is gone. A couple of other banks are teetering. So what rallied last week? Where did the big money go last week? Well, it bought some gold. Gold went to nearly $2,000. American 10-year bonds rallied. So when the yield goes from 4% down to 3.5%, that's a rally. because the price of a bond goes up as the yield comes down. So 10-year bonds rallied. What else rallied? Bitcoin. Bitcoin rallied. So is now a 10-year US bond and Bitcoin in the same basket? That's what happened. So people bought Bitcoin last week. Why not? If you're going to panic, let's panic. Let's really panic and buy. You guys didn't. You didn't buy any Bitcoin, did you, Michael? No. So we've got cash rates going up, long-dated bonds still mispriced, but their yields are going up. The printing of money, it's still going on in Japan, still going full throttle. Europe, well, we're sort of stopping, we promise. America's slowed, wants to go the other way and do a QT, and Australia's not printing money, promise you, at this point in time. But QE remains a policy which could come out at any moment. Now, did QE come out last week in America?
Is that quantitative easing? Is that quantitative easing?
Yeah. Did they print money in America last week? They did. I didn't tell you, they did. So there's the remarkable thing. We're not going to print any more money, and they did last week in America. How do I know that? Because you would have read that the Central Bank of America gave a buyback facility to every bank. If you want to sell us back your government bonds at not market value, but at the cost you paid for them, or at face value, face value. So if you had a 10-year, if you had a 1 or 2 year bond and it was $90 and it was issued at 100, we will buy it back off you at 100. Right? Now, where was that money coming from? Printed money. So just last week, while we're all panicking, the Central Bank of America started printing some more money to liquefy the system, to make sure the system remained liquid and there was no panic. Now, is that good or bad news? I think it's good news. I think it's good that the central bank reacts to a problem and fixes it. It'd be terrible news if they didn't, because you would have had people lining up outside small US banks at ATM machines and going, you know, that's what happened in Greece in 2012. So the way to stop a bank run is liquefy the banks. And guess what? Everyone goes from panic to, oh, what was that all about? And so in the last 2 days, 3 days in America, no one's worried. The central bank did what it had to do, but it was quantitative easing. So it's not gone. Now, all the result of this is, when we printed money aggressively pre-COVID, the stock market rallied quite strongly. Then we had COVID, and we printed, we had the crash in the COVID. Remember the share price market went down 30%? And then they printed more money, and the share market went up. The share market going up is really a massive expansion of what they call the price-earnings ratio of the market. So the PE, the price times the earnings, went up dramatically to give us the end price. So print money, drive interest rates down, share market goes up, as does a whole lot of other assets, including property. Yeah? So that cycle has ended, we thought, but it started again last week. A little bit of printing last week. But one of the results we've got is the share market has come back, more so in America than anywhere, and more so the NASDAQ than any other market, because very high PE markets, their PEs came down dramatically, okay? And that was quite unique. We're seeing a dramatic fall in the price-earnings ratio of the American stock market, and we saw quite a pullback. If you look at the NASDAQ, I think it's come back about 35% from its peak. And the earnings haven't dropped 35%, but the value of the market dropped 35%. So it's a PE contraction. Okay, so that's the introduction. Let's start looking at work out where we're going. Now, this is just an interesting chart. It's a I got this from a Martian. A Martian. Don't you talk? Don't you have Don't you know Martians? The Martians look at the world and see whether they want to invest here. So they look from afar. So the problem we're in the world. We're on the inside looking out. You want to be on the outside looking in. You get a better view. And this is a Martian view of the world. You have to stay with it, because there's going to be. I'm going to take you into very dark places in the next. There's nowhere darker than the solar system, I can tell you that. Anyway, But they can see that 20 odd years ago the world economy was 35 trillion, today it's 100 trillion. It's tripled. So we've doubled and gone up 50%. The world has grown, never stopped growing in 23 years. And we had an internet bubble at September 11, at GFC, European banking crisis, Greece went broke, now Ukrainian war. And despite all that, the best endeavours of mankind, the world's grown. And it'll continue to grow. Funny that. The growth engines are clearly China. At the turn of the century, the Chinese economy was $1 trillion. Today it's about 15 trillion. It's done 15 times. 15 times it's grown. And India, which was smaller than Australia in 2000, is now 2 times bigger than Australia. But Australia's grown from about $500 billion to 2 and a bit trillion. So what's that? We've gone 4-fold, and India's gone 8-fold. So in the world today, there are growth parts of the world, and our job as investors is to try and invest in growth. Okay? You've got a choice to invest in growth and lever off the world growth, or invest in income wherever you can get it. And the trick about income is if you get income and growth, that's a fantastic thing to have at the same time, okay? But we'll come back to that when we look at asset allocation. So the world's growing, and according to the IMF, and I believe that there's no worldwide recession this year. You might have thought there was. There is none forecast. There will be issues for some countries. United Kingdom, they've got an issue. They'll probably go backwards this year. Is anyone English here? I don't want to offend anyone. But they are a backward country. And Russia, I think the IMF is a little bit too... Are there any Russians here tonight? Not that you'd say you were. But I think that's a little bit bullish. I don't see how Russia can grow. Although the Chinese are there today, so they're probably going to give them a bit of a kick along. The Chinese are in Moscow because they want to buy their oil at half price. That seems sensible when you think about it. You know, song and dance, get off the plane, shake hands, salute the army. Can we buy some more oil at half price? That's what I do. I was Chinese. It sort of works. It's sensible. Even India is buying Russian oil at half price. You know, got any Indians here? No, couldn't see any. So the world who wants to trade with Russia is buying their oil at half price. The world who doesn't want to deal with Russia, that's everyone else, you know, is attacking them. But Russia's going to struggle to grow. But forget about all that nonsense. This is the big thing. India, 6.8, 6.1, 6.8 growth. China, bit of COVID growth of 3%, 5%. They came out the other day and said they're going to grow at 5%. And the Chinese usually get what they want in terms of growing their economy. So the two dynamic growth economies, China and India, are going to continue to grow this year. And guess who trades with China and India? Us. That's the good news, guys. We trade with them. We even sent a delegation to India last week or 2 weeks ago. We sent a delegation to India to see what was going on there. Well, there's 1.3 billion people who are growing their wealth. Not greatly, but when you've got 1.3 billion, you don't have to do a lot of growth because it's big. Well, we had to send 160 people there to tell us that there's an opportunity in India to trade with them. Really? You could have read that in a magazine. Could have come to one of my presentations. Anyway, there's no recession. Not great growth outside India and China, but no worldwide recession. So let's take that off the table. Okay? So clear that one. However, we have to look at growth, and I just point this out. I certainly didn't do this last year. And the issue about China is, if you go back, this is a 10-year chart of growth. It's been quite, this is a 10-year chart of fiscal policy, and we know what the growth was. So when I talk about fiscal policy, this was the fiscal deficit. This is the budget deficit of China, right? That's the budget deficit. My point here is in 2013, they had a 1.4% deficit. Okay, so they ran a deficit. That's fine because China was growing. And you wouldn't expect China to run a surplus, would you? This is a budget surplus. They're running a fiscal surplus, okay? Deficit. But in those days, they could spend $1 and they'd get about $6.50 of growth. So run a dollar deficit, get $6.50 of growth. Make sense? That's what I call a fiscal multiplier. In the last year, the estimate is they had an 8% deficit, so they had an $8 deficit and they got a $2.50 growth. So the multiplier has come down dramatically. Now, the question is that a COVID-related issue, or is that becoming systematic? We won't know until a few more years pass. So come back next year and I'll tell you how we're going, okay? I'm not going to make a forecast. I'm hopeful that that is COVID-related, but you're not going to get the multiplier we had in the past. Now, I'm pretty confident about that because it's what I call diseconomies of scale. As China grew, it got economies of scale, and now it's hitting diseconomies of scale. That's an economic term of the rate of return based on incremental investment. Diseconomies, economies, yeah. But over in India, we're getting the opposite. We're getting $1 of fiscal deficits and we're getting $5 of growth. They're going up the economy scale. Okay? So just park that fault. It's my fault, your fault. Okay. Now, this is just reflecting. We're hearing the central banks talk about, oh, we're going to stop printing money. But we have to understand they printed a lot of money during COVID. Now, Japan and Europe and America were already printing money pre-COVID. The ratio here, remember that's 25% to GDP, that's 5, so you can't compare that to that. They are very big numbers on this side of the page, okay? Because they've been printing money for a long time. The late players to printing money, we're in that group, Australia's in that group. How much money did Australia print? We printed $300 billion in 2001, 2002. 300. Was that a lot of money? What was for Australia?
Pay for the subs.
Have we got a book? have we got a prize? I actually said that today at a lunch. You've taken my joke.
Sorry.
So when I go back to it, don't forget to laugh.
I'm sure they'll
That's incredibly... You don't realise how brilliant you are. You should be on Q&A. Australia, you can see, we printed more bonds, we printed more money than bonds were issued. So the central bank printed more money than the government issued bonds. To the point now where the Central Bank of Australia owns about 35% of the Australian bond market. And this is a central bank who said, we're never going to print money, never, promise. There is no housing bubble, we know what we're talking about, and we're never going to take interest rates to zero. This is what they said 3 years ago. Does anyone bet on trifectas? Because that was the trifecta. Would you like some water? You're right? Okay. So, are we going to go to QT? QT is quantitative tightening. QE is quantitative easing. Easing is printing money, tightening is getting it back. How would the central bank get money back? Well, it would sell the bonds that it bought with printed money back to the market and take that money out of the market. If it does that, it's playing a little bit with fire. You know how we didn't know how QE worked, and now we've sort of worked out how it works. You print money and interest rates go down and you manipulate. We don't actually quite understand how QT works. The opposite. I think if you sell bonds back to the market, interest rates will go up and may affect the cost of debt to the government. And the government's highly indebted. See how it's probably dangerous? We'll get back to that later. There's inflation everywhere, you know that. But I had that question mark, why is inflation in Japan only 3%? I think it's 3.5%. And why is Chinese inflation declining? So everywhere inflation has gone through the roof, except in Japan, which prints the most money. It prints the most money, it's got the lowest inflation. That's interesting when you think about it. And China has actually got inflation coming down now. Why? Well, clearly because it's buying cheap energy off Russia. There is a benefit, okay? So they're the outliers and we need to investigate and understand that one. We also need to understand inflation. So what is this inflation surge? Now, I know it's a fairly young audience tonight, so you might not remember the 1970s. Is anyone born before 1970 in the room? Okay, so. Well, this is a rerun of the 1970s, and what we had in the 1970s is a surge in oil prices. And about this time last year, oil prices, we had a little bit of inflation appearing around the world after COVID. We had supply, remember we had the supply problems? We closed down so much because of COVID that when we opened up after COVID, demand jumped ahead and we had a supply issue and prices started moving a bit. That was the first round of inflation. But then we had the Ukraine war and oil prices, which is represented by the green. Don't worry about 23, so that should be 22, but I didn't put that there. It's a 22 inflation. We had the war and oil prices went from about $70 a barrel US to 120. They went to $120 a barrel. So we had, and it knocked on to gas. And we had an issue with gas prices. So all of a sudden we had inflation surging, and that was nearly 1% inflation surge in 1 month caused by oil in America. 1% in 1 month means 12% per annum increase in the cost of energy. Then we had another surge in May and June. And just remember those months because they're going to become important when we're trying to work out where inflation's going, and we have to understand where it's been, okay? So this was very much a cost-driven inflation surge. Yes, there's been some pullback, and this is what's going to come through in the numbers in the next few months in America, that there is downward push on cost inflation, but we've got a little bit of elevated, what they call services inflation. What's services inflation? Well, that's mainly wages. That's wages coming through in America. America is a very unregulated labour market, and there's a lot of low-skilled work, but the cost of those wages are going up as America, certainly as it came out of COVID. So we have to watch that. But essentially we had a cost-driven inflation surge. The latest numbers, so this is hot off the press. So last week America disclosed their inflation, and they said inflation is 6.4%. Or 6%. They said inflation, I remember they all got excited, it was slightly lower than expected. But the problem with that inflation rate is it's 12 months looking back. And 12 months looking back includes the Ukraine war, where oil prices went up. So if you take the last 7 months, which is 4 or 5 months after the Ukraine war, oil prices are subsiding. The last 7 months, the inflation rate is 3.5% in America. So inflation is already dropping dramatically in America. Why is that important? Because America central bank is putting up interest rates, telling us it's fighting inflation, and inflation's falling anyway. Because inflation went up because of oil and gas, and now it's coming down because of oil and gas. The interest rate has no effect on the price of oil or gas. Yeah? In Australia, what do we have? We have interest rates going up, but they're not going up greatly. And it's because of a mortgage problem we have in this country, and I'll get back to that constantly. But there's something else happening in Australia. So last week, while we bought some subs, on the Never Never, we said we're going to buy some subs. And then we had banking crisis last week. Remember the banking crisis? But what else happened last week in Australia?
AFL started.
Exactly right. Have I got a book for you? Huh?
Essendon won their first match.
Essendon. I mean, you know you're talking to a Melbourne crowd, don't you? I mean, honestly. Can we get out of the football game? Can we get back into the real world? Right? What else happened last week?
Give us a clue.
Prediction on prices. What were we told last week regarding electricity and gas? Going up. July 1, 20%, 30%. So whilst the Central Bank of Australia is telling us we've got to put up interest rates to stop inflation, meanwhile the electricity companies and the gas companies say, oh look, by the way, we're putting prices up 20, 30%. We did 20% last year, we're going to double it. And that one went through to the keeper. I mean, that is really, and we were talking earlier about the headwind, that was the biggest headwind which has been created. Now, I talked about Mars earlier, and I think I want to go back to Mars, because there is an entity called the Martian Investment Board, okay? The Martians have an investment company. Did you know that? You're looking at me like I'm nuts. Not you, him. The Martians come down here and they look at Australia, they look at the world, and they look at it from afar, and they say, look at all the world. Actually, the best place to invest is Australia. They are self-sufficient in resources, they're self-sufficient in food, they're a democracy, run by a very clever, no, sorry, forget that. They're legal, they have good accounting, and the people are smart. That's the place we should visit, because we should invest in Australia. So they get off their spaceship. This is only last week. I don't know how you missed it. They got here, and in the first meeting, they're sitting down with Treasury, and Treasury's going, oh, look, we should tell you that energy and gas prices are going up 20-30% from July 1. I said, how could that be? Because we looked at it. You guys are you're the biggest exporter in the world of gas. How could you tell us, and the gas price, what are you doing? So we're putting up gas prices 20%. So how does that relate to your export price? Oh, it's about 30% above the export price. Why are you doing that? I'll get back to you. And what are you doing on electricity? Oh, we're putting them up. But aren't you the biggest exporter of steaming coal? Oh yeah, but we didn't think about it. So they get back on the spaceship and go home. So we're not investing in Australia. We'll come back in a year to see how it goes. And that's the problem. How could we in Australia come up and we run our country and we are the biggest exporter of energy and we can't supply ourselves. Not only can't we supply ourselves, we put the price up 20-30% just at the time the Reserve Bank is trying to get inflation down. So we'll get back to all this, what it means. But that's a headwind which has appeared, which makes me think about asset allocation. Okay? It should make you think. See how much you can get out of a piece of a document like that? Takes you in very strange places. So rising government debt, yes, COVID has sent debt. The governments have just borrowed more in response to COVID, big deficits. Okay? We'll get back to Australia later. Interest rates are going through the roof. Now it's a bit of a funny race. If this was a horse race, Australia was very late out of the barriers. US was very quick out of the barriers and still running very hard out in front. For what reason, I'm not quite sure. And then everyone else, Japan's not in the race, they're not playing the game. They're not interested in being in the interest rate race. Europe is being dragged along. They're up to about 3%. Inflation in Europe is about 9% and cash rates are 3%. Inflation in the UK is 10% and cash rates are 3.5%. Yeah? We've just seen inflation in America is probably going below 4% and their cash rates are 5%. This mismatching of interest rates and inflation, we need to understand what it means. How it affects markets and how it affects currency is the big issue. So hold that thought for later. In Australia, as you know, cash rates today are around 3.5%, 3.6%, whatever they are, well below inflation. And in your working life, in your living memory, you will not be able to recall a period where cash rates were so far below inflation. You've never seen this before. So when we start looking at history and say, well, back in the 1970s, 50 years ago, when we had inflation, this is what happened to the stock market. Well, you can't draw that conclusion because the bond market then was 10 or 12% yield. So how can you compare something where the bond market was 12% with today's bond market at 3.5%? Yes, inflation is as high as it was then in some parts of the world, but the bond market hasn't reacted. And the bond market is important in valuing assets because that's the risk-free rate of return. Remember I said that? Let's investigate that one. Oh, thank God the right chart came out. I must have done this before. So, the last time we had inflation in Australia of above 6%, the Australian 10-year bond was 7%. That was the year 2000, 2001. after the internet bubble, before the September 11. So think about it. Last time we had 6% inflation, the Australian bond yield, 10-year, was 7%. The risk-free rate of return was 7%. And so when you invested money, you'd say, well, if I can get 7% for 10 years risk-free, anything else I buy has to give me a far superior return. To get that return, other prices fall. As the price falls, the potential return goes up. Does that make sense? So as the 10-year bond yield goes up, other assets have to fall to give me a better return on the bond. Otherwise, I'll just buy risk-free bonds. That was the past. The present. Today we have inflation of about 7%, and the 10-year bond in Australia is I think today it was 3.3%. It's actually rallied from 3.6. So the inflation rate is twice the bond yield. Not a very hard hurdle to jump. If I can get 3.3% on a 10-year bond, are you all going to race out of here and buy it? You're probably not. You probably think, well, there's a con there, John. Inflation's 7%, and you want me to get 3.3% and take a 3.7% loss in cash flow against inflation. I don't like that deal. So you're forced into other assets. That's the power of bond pricing, which I don't think, and all the commentary you read, I don't think anyone tells you that. And this is why, even though we're in a new cycle today than where we were 2 years ago, the basis of this cycle has not dramatically changed. Interest rates are still too low. And you know that. You go back to when you bought a home. If you bought a home in the 70s, what were you paying for a mortgage? Last time we had a cost price surge, you were paying double digit for your mortgages. Today, we're paying, 6%? 2 years ago, they were paying 2% for a mortgage. Hold that thought. We'll get back to that. 10-year bonds, a little bit out of date. I got this from the RBA chart book. No wonder it's out of date. Anyway, we're about 3.3%. So we've had quite a sharp increase in yield. That's what Michael was talking about. When we talked to you last time, it was down here. You would not touch a bond with your mother-in-law's money. That's just a joke for the men. Sorry. Offensive, I withdraw that joke. So it was just this, you would not buy 10-year bonds at 1%. Even though that guy told us on the first page, the government shouldn't issue, the government should issue bonds at 1%. If people are silly enough to buy them, issue them. Give them as much as they want. Okay, let's talk about what happened last year as markets retraced, interest rates went up. Now, this is to make Michael look good. Did you get anyone a negative 20% return last year?
Absolutely zero.
Unbelievable. How good are you? One of the best planners in Australia. But I'm not comparing apples with apples, Michael. This is America. This is US residents, so US citizens, who in 2022 put 60% of their money in the S&P 500 and 40% of their money in the American bond market. 60% in the equity market, 40% in the bond market. That, which was historically what people did, the 60-40 rule, that, what they call sort of balanced, that's what they used to say was a balanced portfolio, that produced a 20% negative return, and the worst return in the last 50 years, and I can tell you the worst return since the Great Depression. So last year, American investors, investing balanced, heard that word balanced, they had their worst ever return since the Great Depression. The next worst return was 2002, September 11, late in the year, knocked markets around, remember that? 2008, remember the GFC? The return from that was 11.6%, yet last year's return was 8 or 9% worse than the GFC. Does anyone know why? Because wouldn't the GFC be worse than last year? Shocking. Remember the GFC? We just panicked? Maybe you didn't panic. Maybe we thought the end was nigh. I turned 50 in 2008, and I was an October baby, and I'd planned my 50th birthday in Tasmania. I was taking 20 of my friends down. let's have a game of golf and celebrate my 50th. That's what you do in funds management. So, anyway, and I remember early October I was thinking about cancelling it. I thought, who was going to come to my birthday? I feel sick. No one's going to have any money. We're going to be in a worldwide depression. Call it off, you know. Anyway, we did, and we went down. Doesn't matter. What happened in 2008 to make it 9% better than 2022? Something must have happened. Because I thought 2008 was shocking. The answer is in the assets. So 60% was equities, and I guarantee 2008 the equity market fell more than 2022. But the bond market rallied. The bond market rallied in 2008. Why did the bond market rally in 2008 and didn't do it in 2022? Because in 2008 we had a positive yield. You started American bonds at 5% and they went down to 3 or 2.5. This time we started at 0.1 and they couldn't go any lower, they could only go up. So the bond market crashed with the equity market. And we haven't seen that happen before. Right, so when you read all your stuff, as you do, and you read all these commentators saying, look, things are going to get really bad, and I go, well, how much worse than that? We've had the worst returns ever, and you reckon they're going to get more worse returns. The thing about the stock market in particular is it's predictive. When you feel pain, the stock market's already had the pain for you 6 or 12 months ago. That's what the market does, it anticipates bad news. So when the bad news comes, it's already priced in the market. And again, a lot of commentators don't understand that. They're telling you they're feeling bad vibes in the market, or in the economy, but the market's already priced for that. We have to work out whether the market's right, of course. Just to reiterate, massive meltdown. This is the value of the bond market, down 25%. So if you bought a bond index in America with American dollars, you lost 25% of your money. If you were lucky enough to buy it with Aussie dollars, you only lost half that because the currency fell 10%. Gave you something. Yeah. So shocking. But that's what happens after you manipulate something. Eventually manipulation stops and it comes back to reality. And the bond market's come back to reality and jolted all markets. Having said that, this is interesting because this is balanced investing in Australia, and balance is just not buying equities and bonds. You can buy property, you can buy corporate credit, you can spread your balance. The 5-year returns from a balanced portfolio, a properly balanced portfolio in Australia, looking back, is still 7 to 8%. So we've had a massive decline in the Australian bond market in particular, but even that decline hasn't really knocked the 5-year returns. It's down a bit because the equity market has performed while the bond market underperformed. Quite strange, but that's what's happened. 5-year returns are pretty good if you stay the course and you're properly balanced and you don't panic yourself into a lot of adjustments. The only time the 5-year returns looking back are gone negative was in the two years after the GFC. So we had those negative years coming through the 5-year returns. But you can see over 23 years, sticking to a solid long-term investment process, being well balanced across asset classes, you generally get a 7 or 8% return compound looking back over 5 years. So it's a lesson in that. Don't panic, be patient. You know? Ask Michael when it gets volatile, he'll tell you what to do. Now this is interesting. I was going to ask I've got a 10-month-old grandchild. I was going to ask him if he could analyse this for me because I think it's that simple. So this is the Australian stock market every decade for the last 80 years compared to the world. So Australian shares compared to international shares. And you can see a bit of a pattern developing. You've got to look at it carefully. So 1940s, Australia outperformed. 1950s, Australia underperformed. 1960s, Australia outperformed. 1970s, Australia underperformed. Oh, a bit of an aberration there, we underperformed again, but then we outperformed and got it back again, then we underperformed. It's likely that we'll outperform again in the next 10 years. How's that for brilliant analysis? What it just tells you is, markets revert to mean, averages. So underperformance is followed by outperformance. Then goes underperformance. Yeah? That's what markets do. If they outperform greatly, guess what? They're going to come down. And that's exactly what the bond market did. When it went to very high returns on the bond markets, and all investors were telling you how good they weren't good at all. They just held bonds which were driven down by the central bank, and they weren't smart enough to liquidate them and go to cash before the bond market crashed. Anyway, the Australian share market has underperformed in the last decade. There's a fairly strong argument that we'll outperform, and here's the underperformance in another way of looking at it. So going up, we outperform. Then we go down, we underperform. So the last 2 decades, quite different. Pre-GFC, we outperformed. Ex-GFC, we underperformed. We're probably due for a period of outperformance. That doesn't mean you sell your international shares. It just means you're aware that probably you can be tilted more to Australia. And the tilting to Australia is supported by the currency. As the Australian dollar goes down, eventually it'll go up. And as you're an international investor, you've got to be aware, if you're unhedged, you're going to wear that loss. Yeah? But we'll talk more about that in this allocation towards the end. So hold that thought. How many thoughts are you holding now? I've given you about 10. Okay. Is the share market overpriced or underpriced? Well, this is the last 20 years. So this is the US stock market. Let's just look at the US. So the US stock market has traded between 10 times and 23 times. This is the S&P 500. I'm talking about price-earnings ratios. You all know price-earnings ratios, the multiple of earnings in the market. So the market has gone from a low, probably that was GFC, to a high, and that was probably not far after COVID. Yeah? So we've gone from about 10 to 23. The average over the period is 15, and the pink dot is today, it's about 15. So we don't look to be very expensive based on 20 years of trading history. And given the bond yield today is only 10-year bond in America is 3.5%, and we know the relationship between bonds and equities, doesn't look expensive at all. And it's true when we go to emerging markets, Eurozone, Japan, blah, blah, blah. Everything seems to be at the low end of the 20-year range and below averages. So just looking at that one, doesn't look like the equity market's very expensive. Okay? Doesn't look like it's expensive. That's just another observation. Whilst we read all these terrible reports from journalists. And I say good news, we've had a serious correction in the US stock market. Nasdaq down 35%, S&P went from top to bottom down 20%. We've had historically high falls in those markets. I can tell you, and you saw the chart earlier, it's very rare, in fact it's never happened, that a significantly negative market is followed by another negative market the next year. Not saying it's impossible, but it's more likely not to happen than to happen. The markets are predictive, particularly the equity market. And the equity market's been on red alert for the last 12 months because of all the issues which are occurring around the world, which is on my white swan chart. Okay, so let's come back to Australia. This is interesting. You know, we've seen this is the fastest increase in interest rates we've seen since 1994. 1994, is that the recession we had to have? I can't remember. I think it was. I'm too old to remember that. Anyway. I remember the Banana Republic. Remember that one? That was 80. Was that 84? 86 was it? Funny how you can remember things. Does that mean I'm getting dementia? I can remember 86, but I can't remember 94. Yeah. Anyway, in 1994, so we've got interest rates going up faster and further this time than 1994, the recession we had to have. I've given you the answer, but what's the difference? The difference this time is the starting point. This time we started from 0.1, then we started from 4. So when interest rates went from 4 to 7 to 8, that was quite significant, quite a significant adjustment. This time we're taking interest rates up from 0 to 3.5%. I think you might be getting term deposits. What are term deposits now for 12 months? You might get 3%? 3 and a bit, yep. Depends if you're wholesale or retail. You just gave it away, didn't you? We need to see this, man. So this is a quick adjustment to interest rates, but it's coming off a very low base. The outlook, and I caution you, this is from the federal budget in October, and the federal budget in October is so wrong it's embarrassing. We'll get back to that. But in the October budget, the forecast for growth in Australia is around 2%. I think 2023, yep, will probably be a bit lower. but the outlook for 2024 was quite strong. After we get an inflation issue in the middle of 2023, by 2024 we get quite a lot of tailwind from immigration. So Australia's growth looks fairly assured in a world of low growth, and we've also got the trade coming in from China and India. In the 2022 October budget, and I can't even remember it. Does anyone remember the October budget? Because I don't know what happened. I must have been somewhere else. Does anyone remember it? No. Something happened on that night, but anyway, it doesn't really matter because what he told us is totally wrong. When he comes back, so he told us that the deficit, so the difference between tax collections and payouts, we were going to collect about 2 to 3% less GDP in the budget, so we're going to collect 2 to 3% less than we're going to expend. The forecast budget was 30, 40 billion deficit. The deficit in Australia for this year is going to be less than 10 billion. So with 6 months down, they couldn't even predict it. They got it wrong. So in May, we're going to have a budget update, and it's probably going to be very close to a balanced budget. So this is interesting, but not relevant. The point is that when the government runs a deficit, it stimulates the economy. When it runs a surplus, it takes away from the economy. Australia will be supported by deficits as far as you can see. Should we be worried about those deficits? Depends on our growth. If you have a deficit below growth, no problem. Remember I talked about China? When you've got a deficit higher than growth, you've got a problem. Okay? Now Australia's deficits, apart from the COVID, where we went haywire, I think we ran an 8 or 9% deficit. We got 6% growth for a little period because we pumped it. Normally we don't have big deficits, but we get solid growth. When we grow debt, we have an issue, and this is what the Treasurer is trying to explain to us. He's not very well, but he's trying to. He's trying to say that we've got an intransigent part of the budget deficit. It's intransigent because we've got so much debt now following the GFC. As interest rates go up, we'll be spending more on paying interest. A bit like our kids with their mortgage. It's the same arithmetic. So he's going to tell us in May, look, I've got to get the budget under control because I've got to start paying interest on the debt I issued to the central bank. They gave me 300 billion at no cost. When it rolls over, I'm going to have to pay 1, 2, 3%. So it's going to come through the budget. And it's going to eat into my revenue. Does that make sense? That's what he's going to tell us. Is it a big problem? Well, it's a problem. But it's not a big problem. A big problem is when you are in America and you have $32 trillion of debt and interest rates go up 2% and you pay $500 billion more interest on a budget of $6 trillion. That's a big problem. The problem, it is an issue for Australia, but the bigger problem is in America, in France, in Germany, in Portugal, in Spain, in Greece, in Italy. The way to fix the problem is go to Japan, print money and hold interest rates down. Hold that thought. Now, let's get on to mortgages. I've got the numbers in my head because I read them this morning. Australian mortgage market is about $2.25 trillion. So the borrowings of Australian households for a mortgage is about $2.25 trillion. There's probably 300 or 400 billion which is investment loans and the rest is pure mortgages. Now what we're getting is this rolling of fixed mortgages into floating. You've read about this. And the bulk of it, the major part of it, is 800,000 mortgages coming from fixed to floating by June. From now to June, there's 800,000 mortgages. There's another 200,000 or 300,000 in the December half, and then 2024 there's 400,000 mortgages going from fixed to floating. What does that mean? Well, everyone in this room would know someone, or know someone who knows someone who borrowed fixed. They're young people, probably in their 30s, starting a family. My niece, who's 35, she was telling me the other night she borrowed $900,000 on a $1.15 million townhouse in Sydney, but she got 4 years at 1.9%. So it's end of 2024. She said, what's going to happen? I said, I don't know. I'm an economist. How would I know? That was a joke. I'm surprised you didn't laugh. So we've got all these rolling. So what's it really mean in dollars? The estimate is as all these loans roll from fixed to floating, there's something around $70 to $80 billion in interest has to be paid. So people go from fixed, they're going to have to pay $70 to $80 billion more in interest. So when you cut it back, that's about $7 billion a month. That's about $1.56 billion a week. So it goes from money which people had at their disposal, and now they don't have it at their disposal anymore. So a year ago they could spend and go on holidays and, you know, buy new furniture and just go to Bunnings and go to Harvey Norman and go out for dinner, you know, just go out to dinner, see a show, $400, who cares? All of a sudden that discretionary expenditure disappears. Because there's no discretion, you have to pay the bank the interest. So there's a bit of a jolt coming, isn't there? And what makes the jolt worse when you think about it in the June quarter? So if that wasn't enough for you, we're going to put up your interest rates by 2 or 3% when you roll. Let's give you another kick by putting up electricity by 20 and gas by 30. Let's give you, we don't think interest rates is enough, let's really give you a hit in the head. So you ask me what's going on, there's a bit of a headwind appearing, okay? Now, if I can see it and I can show you it, guess what? I'm not the only smart guy in town. I know you think I'm telling you something that no one else knows. I wish it was true. The market already knows that. The Central Bank of Australia knows that. That's why the Central Bank of Australia this morning, and you're not home watching the ABC News, but the minutes came out from the March meeting, and guess what they said? They said, oh, we think we might hold interest rates in April. It's on the newswire tonight. We might hold interest rates. Why? Because of this. Can I swear? They're shit scared about what they've created. The mismanagement of interest rates and housing and credit in Australia is another catastrophe. You don't have to be on Mars to see it, you only have to live here. It's an appalling economic management, which, look, it's been good for us as owners, and I'll show you that shortly. It's been good for us, but it's only good for you when you sell. If you're not selling, it feels good, but, and I can assure you, you don't want to borrow against your house. Please, no one in this room, don't borrow against your house to put in the share market. Just own your house and be happy. Because a lot of people are struggling to own a house. Let's talk about the Aussie dollar. You know, this trade surplus gets bigger and bigger, so we're trading very profitably with the world. Not so long ago we couldn't. We couldn't make money trading against the world, but now we're trading profitably, mainly with China. And normally that's good for your currency. But the currency's falling. So our our index is improving and the Aussie dollar's falling. Why is that so? Any ideas? Because we've got a surplus on trade account, we've got a surplus on current account, we haven't got a bad fiscal situation, we haven't really got a lot of government debt. So why is the Aussie dollar so weak? It's because our inflation is so high and our interest rates relative to inflation are too low. So if you look at America today, they've got 5% cash rates, and I explained to you that their inflation is going to go below 4. So their interest rates are above inflation. Australia is the opposite. We've got inflation of 6. We're about to give ourselves a 20% increase in electricity prices to make sure inflation... We just don't want inflation coming down here in this country. We don't want to do that. So we've got high inflation and we can't put up interest rates. So when you're a trader of currency, the interest rate differential drags you out of Aussie dollars if you're a non-Australian. So that's the weakness which is hitting us. We should not be weak based on trade, but we are weak based on interest rates and inflation. But the Australian economy will grow. Doesn't really matter who's running the place. We're going to get a tourism influx. As the Aussie dollar falls, you might stay at home, you guys. Anyone planning an overseas trip? Have you told Michael? Have you paid your bills before you go? You going to come back? Anyway, it doesn't matter. Like, we'll slow down. We had a bit of a surge. Everyone got on a plane or a boat and just went off. So a lot more people staying at home when the Aussie dollar falls. But a lot of people coming here, so we get a tourism surge. We're going to get education. Hundreds of thousands of people are going to come here to be educated, like they were pre-COVID. And we're going to get 1 million people in the next 4 or 5 years coming and immigrating here. That's all positive for the Australian economy. You might not like it, but it's positive. So there's the population growth. So that's what COVID did. We lost people during COVID. Where did they go? Yeah, all those people that went overseas and didn't come back.
Can I ask you a question?
Yeah.
What makes you think that students will come back to study?
Oh, good question. There it is. So there's the students during COVID. That's what we're seeing, the recovery. Now, that's pre-COVID, so there's seasonality, and the numbers came out. I haven't seen January, but we're running at about 19,000 per month now. So November, December, about 19,000, mainly weighted to Indians and Chinese. So we're seeing the people, but we're not back to pre-COVID, but there's no doubt we'll go back to pre-COVID. Definitely the Indian trade delegation was promoting education, and we're not filling it as much in here, but there's a lot of Indian education on the west coast of Australia, Perth. They're seeing a lot of it because it's easier to get to Perth than Sydney or Melbourne. And the Chinese have told their students they want them to go overseas. And
I hope you're right. I would imagine with online learning now as it is.
yeah, but the Chinese have told them they want physical learning. They want them to
I hope you're right.
No, that's happened. So good question. It's actually happened. They're directing them. And with the weak Australian dollar, we've become more attractive. So it's either come to Australia or go to Europe or go to America. We're closer, same time zone, and our currency's weak. Who said that? How many bedrooms have you got? It's a big opportunity for you. Housing problem, housing opportunity. So when we think about stocks to buy in a difficult environment, maybe we should buy some builders in our portfolio. Brickworks, maybe a good company. So that's how we think. We look at the issue, what's going on, then try and go, well, what's that mean? What's that macro view mean for stock selection? And we need to think about it. And we even had that discussion today. So we've got a headwind of inflation, interest rates rising, higher electricity prices. We've got a tailwind of population growth, tourism, education. So how do we play it in investing? Well, one thing we thought about today is buying stocks which are non-discretionary expenditure. So there's a discretionary expenditure issue because of interest rates and inflation, cost of living, but people have to buy food. Yep. So Coles and Woolies become interesting. You think about they're not going to suffer. Okay. Then you think about what else is not going to suffer. Probably telcos. More people use more telecommunications. Maybe Telstra comes back into play. Building. We're bringing all these people, haven't got enough houses, we build more houses. Brickworks. You see how you connect the macro dots to stock selection. I'm getting near the end. How long have I got? Crikey. Is anyone enjoying this or is it just me? Okay. The biggest issue, another big potential, we've got a wage case going on at present. The ACTU wants a 7% wage rise, apparently. We had a wage rise last year for low-income earners. We've got to watch what's going on in terms of real wages in Australia, despite what you're told, have always gone up over the last decade. Real wages have fallen as inflation's gone up because wages haven't matched inflation. So that's just real wages and inflation. So we've had a decline in real wages, but real wages have gone up over the last decade. What we don't want to see is a wages explosion like we saw in the 70s and 80s in Australia. Now the unions, anyone a unionist here? So just before I say something, we don't want a wages surge and an outbreak of industrial warfare. We don't want that. Now it's unlikely to happen because the unions are less significant now than they were, but they do have some sway, and their biggest sway is in the low income earners. So the services, aged care, child care, some parts of education, services in terms of hospitality, restaurants, cafes, yeah. Now, so the low income earners, absolutely they need a wage increase to match inflation, because they get $1, they spend it. We have to protect them, but we don't want them used as a battery ram by the union movement, because guess what happens? If you give someone on $50,000 a 7% wage increase, guess what someone on 100,000 wants? A 7% wage increase. And 200,000, oh, we want 7%. It goes right through the economy, and we've got to watch this, because this could become an issue, and it will be an issue if the government doesn't do something about it. And the obvious thing to do is to sit down with the unions and the Business Council and say, look, what about we give you a significant tax cut for low income earners, get rid of stage 3, give a low income tax cut to people who are doing low paid jobs. And if you think about it, what's going to happen? And it's just an observation. If we're going to bring 1 million people into Australia in the next 4 years, where do you think a fair amount of them are going to be working? In what sort of jobs? Now, I was watching... Services.
Anything that we don't want to do.
Yeah, that's my line. Who said that? Yeah, all the jobs we don't want to do as Australians, we bring in people to do those jobs. And some of them have to do 2 jobs just to get a fair pay. Now, if we're going to bring these people in here, we've got to make it livable, and they've got to be able to live here on a fair wage. So we're coming to the point where the Labor government's going to have to stand up as a Labor government and do what Hawke and Keating did in the 80s and sit down with unions and the Business Council and say, look, we don't want a wages explosion. We want to give a targeted tax cut to people who are working on low income to ensure they can get over this cost of living hump. Would anyone in Australia object to that? I really don't think they would. Because the one thing you don't want as retirees is inflation kicking up, because you'll never get that back. It's in everyone's interest that we stamp out inflation. And putting up interest rates is not going to do it. It's going to create a worse problem. So, leave you with that thought. That's not something you have to worry about, just something to think about. And this is my chart about COVID. How good was COVID, particularly in Melbourne? You know, you had lockdown, and while you're getting locked down, you're making lots of money. I mean, can we have another COVID surge, get all locked down by 6 months and just get on the Zoom and just talk to our kids, you know? Don't have to feed them, you know? But whilst we were all locked down, we had a surge in property prices and our wealth of Australia went through the roof. And of course, when you get a surge like that, there's a downside, and we're going for the downside. But the wealth of Australia is very strong. But I just want to point this out. It's the dwellings which we have to think about. So the estimate in Australia is about $9 to $10 trillion of residential property. Okay, how much debt's against that? $2.5 trillion. That doesn't look like a lot of debt, does it? That's 25%. Okay, does that make sense? 2.5. But the problem is, of the $10 trillion, about $7 trillion, I'm making up numbers, but they're pretty close. $7 trillion, that's no debt. No debt at all. But about $3 trillion has about $2.5 trillion of debt against it. That's the leverage problem which Australia's created for, yeah, there's a bit of investor in there, but the next generation is being loaded up with debt to buy a property. And everyone thinks that's success. Everyone talks about success for Australia, property prices go up. Not understanding that it's also creating a major problem. Getting very close to the end, I am. Here we are. So where does that take us? I didn't do my joke about your QE, which you're right. And I was thinking the other day, you know, we did that submarine deal, and I don't know, was it 360 billion or 460 billion?
358 or something.
358, yeah. And they said, how are we going to pay for it? We could do a submarine levy. Do a sub-levy for the next 40 years. Well, that would suit us because we're all going to be dead in 20. So we only half contribute. Only joking. I'm not going to do that. So we have a sub-levy. Someone said, but your point is right. How did we print $300 billion in COVID when we're all at home, but we can't print $300 billion to pay for subs off the UK, who's bankrupt? The UK's, you know, they're hopeless. They take Aussie dollars.
But it's 350 billion over 30 years as opposed to
Yeah, but-
300 billion over 18 months.
You know, let's just print the money now, put it in the bank and dribble it out to them over every... You're right. And guess what the Australian economy is, just because you're absolutely right. How big will the Australian economy be in 2060? Well, based on current run rates, it'll be somewhere close to $8 trillion. So all of a sudden, 300 billion on 8 trillion doesn't seem so much. Yeah. So inflation will... But
The other number is, of course, that the subs are only adding about 0.25% of GDP of the defence. So it's only adding defence from 2.1 to 2.3%.
You work for Treasury, don't you? I asked you whether you work for Treasury and you said you didn't. He's quoting numbers. Look, I think the one thing we know after the NBN is that whatever they say something's going to cost, it's totally irrelevant. It's just absolute nonsense. But I just wanted to make the point that we could just print the money. We could print 10 billion a year for the next 30 years. That would pay for it, okay? And who would know if we printed the money? And what would be so bad with it? Japan's printed about $10 trillion. They've printed about $10 trillion. So what's so bad about us printing 300 and paying for some crap submarines? Second-hand ones from the UK. What's wrong with that? Anyway, I'm being a little bit silly there, sorry. Okay, so this is the speculation. I should underline it because I don't want you coming back in a year, if I'm invited back, Michael, because you know I know you're a tough... Is it okay?
Yeah.
You might not like it if I get everything wrong. Good answer. We practiced that before. Yeah, okay. So what's happening? US or forecasting, we think there's going to be a downgrade again in growth, but not dramatic. And as we speak, there's upgrades in growth in Europe. Can you believe that? They got so depressed because of the Ukraine war, they said, oh, recession in Europe. There's no recession in Europe, a bit of recession in the UK. But we no doubt interest rates are going to slow growth, but expect a recovery. So I think a slowdown in economic activity is well in the markets. A recovery is not priced in as yet. Okay? Recovery is not priced, but the world always grows. Remember that one? Now, when will central banks pause? Pausing means stop putting up interest rates. We've heard from the Australian Central Bank today that they're going to pause in April. They're probably going to pause in May because they want to see what the budget's doing. Which is not silly. What are you going to do? Because if you do something sensible, we don't have to put up interest rates. Yeah? So all of a sudden fiscal and monetary policy come together. In America, they're in a bit of a turmoil because of their bank collapses. So I hate making short-term, short-term forecasts because people remember short-term forecasts. So if you're wrong, they remember it. Long-term forecasts, who remembers it? I think they'll probably put up interest rates 0.25% next week. Not 0.5%. And I think they're going to stop around 5, if not below it. And already the futures market is saying, at one stage they thought interest rates in America would go to 6%. They don't need to go much higher because inflation's coming down already. I showed you that. Okay.
I think people need to remember that in the late 90s, that idiot Keating pushed it into a position where interest rates that we were paying on business were 24%. Businesses were collapsing all over the country.
Yeah.
So there is a happy medium between.
Yeah. And what's the next big crisis for businesses? I don't think it's interest rates. It's every small business uses energy, power. I mean, I don't know how many of you know, you talk to when you have your coffee and talk to your cafe owner, how much he's paying for power today. And if he starts putting through 20% increases and 30% increases in power, it won't matter what interest rates do. And, you know, it's going to be very interesting to see what the budget does in May to fight back against that, because if it doesn't do something, the Reserve Bank may have to cut interest rates because the cost of doing business is going up dramatically. And if we get wages on top of that, we've got a real problem in the small part of the owner-operator, which I think where you come from, maybe. Yeah. So it's very important we watch interest rates and the cost of doing business. Now, I'm still negative on bonds. Bit of a rally. The short-term rally, don't worry about it. Bonds are mispriced. They should be 4% and higher. But if bonds went to 4%, it doesn't really rock the stock market. The bond market's mispriced, and I think the stock market knows it, believe it or not. We're smarter than bond traders. He laughed. So look, if bonds go to 4%, no problem. Bonds go to 4.5%. If bonds go to 5%, then the share market will pull back again. Because 5% looks attractive. 4% doesn't look that attractive. 3.5% is totally unattractive. So we've got to watch that. Inflation definitely falling in the US, but Australia, we're probably at the September quarter. And that's what the Reserve Bank's going to tell us. Crikey, we thought inflation was going to peak around March, April. We've got another leg with energy prices. So that's a bit of an issue. That's a headwind. Australian inflation higher than the US, interest rates lower, Aussie dollar under pressure. What's under pressure means 65 to 60, where we are now, that's under pressure. The long-term average of the Aussie dollar is 75, so we're way under our long-term average. We are trading very well for the world, yet our currency's falling. It's being driven by that. But we have to watch this because this can turn very quickly. I think we're under pressure for the next 6 months. But this time next year, I think we'll be well above 70 cents again. You just have to be aware of that, okay? You don't give up on international investing. You stay invested in high-quality international companies. And every downturn is followed by an upturn. So, you know, you guys have been around long enough, you know cycles. And I showed you the cycles in some of those graphs. Final chart. This is what you talked to Michael about. You know, how do I allocate my investments? This is a very simple matrix. Doesn't really mean anything, but it does show you how one input changes asset allocation. The input is age. As you get older, you adjust your investments. But age is not the only thing. You need to have a lot more. You need to understand your personal circumstances, your super and non-super wealth. You know, it goes back to that comment. You saw the free, I don't know if anyone wants to ask, but the $3 million superannuation discussion. Remember that one? Have you forgotten already? It's still live, guys. Yeah. Now, I was quoted in the press a few times, and one thing I've learned about the press is you're better off not talking to them because they never get what you say correct, okay? Now, if I don't have anyone read it in the Australian, I was on Media Watch 2 weeks ago. Anyone see me on Media Watch? Good. You don't watch the ABC. The guy had a go at me because he said, oh, this John Abernethy gooseball from Climb, he said $3 million in super is not a lot of money. What an idiot. What's that effect? Well, the thing about $3 million, so $3 million in super is not a lot of money. So let's look at two people, both with $3 million. If you have $3 million in super but don't own a house, is $3 million a lot of money? If you own a $3 million house and have nothing in super, is $3 million a lot of money? And what it says is circumstances are different with individuals. You know, if you have a $3 million house and no super, you get the pension. If you have $3 million super and no house, you don't get the pension. You've got the same value of assets, but you're treated differently. That was what I said to the Australian, but when it was printed, it went off the light. Yeah. So anyway, I'm not defending myself. I just want to get off my chest. My point is, when you talk to Michael,
$3 million is, of course,
huh?
they're treating the $3 million as if $1 is going to be taxed differently to the first dollar after $3 million.
Yeah.
And that premise, the media is not getting that.
So lack of indexing, and not only treated differently, not even taxed differently, but treated differently, as you say, because we're going to get into unrealised gains. We're going to tax unrealised gains on super. So when you have a good year on an unrealised gain, but you don't sell it, you get taxed. When you have a bad year, you don't get the tax back. Like, if you know what thought bubbles are? That is one. That is a thought bubble. And the scary thing is that came out of Treasury. The scary thing is we pay Treasury a lot of money to come up with smart ideas, not dumb ones.
Maybe
right?
we don't pay Treasury.
You are from Treasury? Is he from Treasury? Because he's... Anyway, my point is, and I'm going to go for this little dot point, but when I saw you a year or so ago, we had no bonds. Now we're introducing bonds, but for more conservative people. None of you in this room are that age. No. Are you in that? Anyone? No. As you get older, you go more conservative and you look for more income. A year ago, we had no bonds anywhere, but now we're looking at 3-year bonds and less. Because the 3-year bond market, you're getting around 4.5%. So, you know, all of a sudden, but also what's appearing is we're getting a very good yield on corporate debt. I think you probably look at corporate debt. So, you know, what do I mean by corporate debt? I don't mean, you know, lending against property developers. I mean good companies like BHP or Rio Tinto or some of the big banks or international companies, you know, General Motors, Apple, Microsoft, you know, their bonds yields are going up. And I'd actually say that a Microsoft bond's a better risk than a US government bond, but that's just me. So we are beginning to see good yields, and we're looking at 6% yields on 3-year bonds by highly rated international companies, including Australians. So all of a sudden that's appearing as an opportunity. We don't have to go there yet, we stick here. So that's something to think about. We talk to Michael and the team about that. And be realistic about what your returns are. Yes, when you're younger you can take on more risk and your returns should be better 5 years looking back. But as you get older you don't need to take that risk. You want to secure your capital as much as possible and you want to generate enough cash to pay yourself a pension. But that's a discussion you have with the advisor, okay? But hopefully I've presented what we're dealing with. You know, it's the world is, yeah, I hate the word stable, but the world's never stable, come on, you know. But we've got a whole lot of white swans, which I've identified. They're all playing off. A couple of little swans going off. What can happen? What could go wrong? We don't know about it.
Nuclear war?
Oh, Jesus, why did you say that?
It's been on the news a bit.
Has it? Yeah, well, that's not going to happen. Oh, bang. It doesn't matter, you're right. We're like, you know, if you're worried about a depression, it won't matter. If you're worried about a depression, I won't be seeing you next year. Because you won't be worth talking to. So, you know, we just stick to your investment knitting, work it out with your advisor. You know, yes, there are times when you can pivot a bit. So a pivot to me is introducing bonds at a certain maturity, when a year or so ago we wouldn't have. So as interest rates change, we can bring in new asset classes without taking on more risk. Okay? Now hopefully, crikey, how good was that? And we missed maths, but we're going to tape it. You know, and it's all about Perth. You know the two people from Perth who are going back to see the sister?
Yeah.
They're both, what are they, gaslighters?
No, only one.
They're both gaslighters.
Not enough alcohol next year. Just disclaimer for the
Yeah, sorry.
room. Age is not the only reason for asset allocation. There's other factors.
That's what I said there.
All right. So first off, just round of applause for John. Thank you. As usual, exceptionally good economic update. You know, full of insight, bit of humour.
Not much.
I've only got your jokes though. Some economic jokes. So there you go. Did say at one stage, yeah, look, I'm not going to make a forecast. That's a first. So to your niece, so you don't want to get in books with her, which is understandable. But look, yeah, my key take out is that yeah, last year was ordinary. We know that. But guess what? Lucky you're not in the US looking at a balance fund over there, because no one in this room returns anywhere near like that. It was, yeah, significantly better than those numbers. There are opportunities, and as John has pointed out, downturns don't last forever. There's always opportunities, and you know, we take long-term views. Yes, we do a bit of tinkering. Yes, we use some different, you know, various fund manager or super manager accounts that will look at some of this stuff, make a decision around corporate bonds and you know, opportunities. So there are opportunities, and I'm really glad everyone came out tonight. It is volatile, we know that. It has been an ordinary 12, 18 months with everything that's going on. And I'm really glad that, you know, that everyone's here to understand that, you know, that if you're in for the long haul, you're going to be fine. But not everyone. If you know of people, though, that are worried about their portfolios, whether they're self-directed or they're not getting the proper advice from people, their taxi driver, I mean, from their advisors, then I think it's important that, you know, that happy to talk to them. Everyone in this room is a VIP client. Everyone here, you know, it's some of our really good clients are in this room. So if you know of anyone, whether they're, you know, kids or brothers or sisters or friends, then we're here to help. And of course, you know, we're here all the time, whether it's myself or Katie or Michelle or, you know, Sally and Heather, to answer your queries and handhold you if necessary, not physically, but about, you know, if necessary, you know, during the hard times. And sometimes the best thing you can do is sit on your bottom lip. So, thank you for John. We probably don't have enough time for questions.